You might have seen headlines like that floating around. But the real story, the one the data actually supports, is far more interesting and frankly more revealing. Forget about a supposed margin cut for a second. Let's talk about what really happened. In early 2026, silver went on an absolutely historic run, blowing past $100 and even topping $120 an ounce. The market was electric. But just as it reached a fever pitch, the CME, the exchange that sets the rules, stepped in, not to help the rally, but to kill it. They didn't cut margins, they hiked them, repeatedly. This isn't a theory, it's a fact. In this video, we are going to break down how the CME used margin hikes as a weapon to crush the biggest silver rally in years, and what it tells us about the widening gulf between the paper price and the scramble for real physical metal. The numbers don't lie. So, let's get this straight. The Decoded official story is that margin requirements are just a tool to manage risk and market volatility. When a price moves up too fast, they raise the collateral needed to trade, cooling things down. It sounds reasonable on paper. But what happened in early 2026 looks less like managing risk and more like strangling momentum. As silver was making headlines, the CME group hit the brakes. On February 6, 2026, with the price screaming higher, they jacked up margin requirements from 15% to 18%. This wasn't some minor tweak. It was a direct shot at anyone holding a long position. Suddenly, it became much more expensive to bet on silver going up. This is where the reality diverges from the textbook explanation. Was the market truly just too volatile, or was the price getting too close to a level that threatened some very powerful players? When you see a rally with this much force get smothered not by sellers but by the exchange itself, you have to start asking questions. It suggests the futures market isn't just a place for price discovery, it's a place for price control. To really get how powerful this margin hike weapon is, you have to look at the cause and effect. This isn't a new trick, it's a classic from the price control playbook. Think about the timeline. Late 2025 and early 2026 see silver explode. It's the talk of the financial world. By late January 2026, it peaks at a stunning $121.67 an ounce. But the exchange didn't just let the market run, they choked it off. After hiking margins to 15% in January, they doubled down with another hike to 18% in early February. This move has one purpose: to force liquidation. See, when margins are hiked, traders who are using leverage to hold their long positions suddenly get a call from their broker demanding more cash, right now. If they don't have it, they're forced to sell. This forced selling creates a domino effect, pushing the price down, which forces even more selling. It's a vicious cycle, a classic leverage unwind, and it worked like a charm. Silver's momentum shattered. The price plunged from its highs, crashing all the way back down into the 70s within days. They didn't just break the momentum, they broke the market's back. Now, let's look at the other side of this story, the physical metal itself. While the CME was busy using paper levers to slam the price down, a very different story was unfolding in the vaults. The demand for actual physical silver was relentless. This isn't just a feeling, it's in the data. The delivery numbers for early 2026 were showing extreme stress on the exchange. February, typically a quiet month, saw an unprecedented number of contracts stand for delivery, translating to tens of millions of ounces of physical silver being demanded. January was even bigger. The amount of silver that was claimed for delivery in just those first 2 months of the year represented a massive portion of the entire registered inventory available at the COMEX. The exchange was bleeding metal, and this has been a long-term trend. The registered silver inventory, that's the silver ready and available for immediate delivery, has been dropping for years. We're talking about a buffer that is becoming razor thin. So while the paper price was being manipulated downwards, the demand for the real thing was sending the opposite signal. A global scramble for physical metal is underway, and the vaults are feeling the pressure. If you think a 40% price crash right after the exchange hikes margin smells fishy, hit that subscribe button. We follow the data, not the official narrative. And drop a comment below. Do you think the CME was just managing risk? Or were they protecting the big banks from a price that was getting out of control? I want to know your take, so let's connect these dots. You have a silver price on a historic parabolic run. You have physical demand so high that it's draining the exchange vaults at an alarming rate. And then, at the peak of the frenzy, the exchange regulator steps in and makes it significantly more expensive to participate in the rally. Why would they do that? Why kill the golden goose? The official answer is managing volatility. But the timing and the effect look a lot more like a targeted intervention. A soaring silver price, backed by a run on physical metal, is a nightmare scenario for anyone with a large, concentrated short position. By hiking margins, the CME gave these shorts the perfect tool. It triggered a wave of selling from leveraged longs, creating downward pressure that had nothing to do with market fundamentals. The This allowed the shorts to contain the price and, in this case, violently reverse it. It looks less like a simple operational adjustment and more like a preemptive strike to protect the system from a runaway price. It was the anatomy of a perfect takedown, ensuring the paper price of silver did not reflect the intense demand happening in the physical world. So, what's the real takeaway here? It is simple. The gap between the paper price of silver and the reality of the physical market has never been more obvious. What we witnessed was a clear demonstration of how the futures market can be used to suppress a price that the physical market is desperately trying to push higher. The delivery reports tell you that users and investors are demanding real metal, not just paper contracts. The dwindling vault inventories tell you there's a genuine supply squeeze. Yet, when the price finally started to reflect this reality, the CME stepped in and used margin hikes to crush it. This confirms the core belief that many of us in this community have held for years. The paper market is a tool for price suppression, not just discovery. The true value and ultimate security are in owning the physical asset yourself. The actions of the CME aren't a sign of a healthy market. They're the actions of an entity trying to manage a situation that was rapidly slipping from its grasp. For anyone paying attention, the signal is crystal clear. The physical market is screaming scarcity, while the paper market is being used to mute its voice. To wrap it all up, silver went on a monster rally, nearing $122 an ounce. As this happened, physical demand was draining COMEX vaults. Instead of letting the market run, the CME hiked margin requirements multiple times, making it more expensive to bet on silver. The result? A price crash of over 40% that had nothing to do with fundamentals, and everything to do with a forced leverage unwind. The vaults don't lie, the delivery reports don't lie, the paper games are becoming more blatant, because the physical situation is becoming more urgent for those who need to keep a lid on the price. The real question is, how long can they keep this game going? I encourage you to check this for yourself. Look up the CME Group S-margin announcements from January and February 2026. Look at a silver price chart from that period. The numbers are all there. The game is being played right out in the open. Stay sharp, and we'll catch you on the next update.